Purchases of trading stock are deducted under Section 8-1. However, deductions are deferred until the year the stock becomes on hand. This may affect prepayments. In accordance with Section 70-45, at the end of the financial year, stock on hand must be valued. To determine whether stock is on hand, we look at whether the taxpayer has the power to deal in the stock. This applies even if it is not in the taxpayer's physical possession or even if it is not legally owned. When valuing trading stock on hand at the end of the year, the taxpayer must elect to value each item at either cost, market selling value, or replacement value. Each item refers to each asset being specifically identifiable, in which case each line or type of items may have its own election of valuation method for the year. Consider a company that sells 3 stock items, with the valuations as shown. In order to minimise taxable income, the taxpayer will choose the lowest valuation method for each item to achieve the lowest closing stock value. But why is this beneficial? The closing stock balance at the end of one year becomes the opening stock balance for the next year as per Section 70-40. An adjustment is made in accordance with Section 70-35 to assessable income or deductions based on the movements in the stock balance. Therefore, an adjustment to assessable income will be made where closing stock is higher than opening stock, and an adjustment to deductions will be made where closing stock is lower than opening stock. This is necessary because under Section 8-1, purchases are deducted regardless of whether the stock is sold that year in accordance with Section 70-5. Section 70-5 taxes trading stock on the basis of purchases for trading stock on hand, not when the expense is accounted for on the sale of the stock. In the accounting statements, sales income is reduced by cost of goods sold expense, which reduces net profit. But for income tax purposes, the tax deduction for the stock sold already occurred when the stock was purchased. Therefore, an adjustment needs to be made to add back the accounting-based cost of goods sold expense. This adjustment ensures that only the trading stock outgoings on purchases are deducted for income tax purposes. So based on our closing stock value of $1,500, if our opening stock value was $800, what adjustment do we make? As the closing stock value is higher than the opening stock value, we have a stock increase, and therefore we adjust assessable income. The amount of the adjustment is equal to closing stock less opening stock. In this case, $1,500 less $800, which is an increase adjustment of $700 to assessable income. If our opening stock value had been $2,000, then we would have had a stock decrease under Section 70-35(3), and would therefore do an increase adjustment to our deductions of $500. That is $2,000 opening stock less $1,500 closing stock value. To recap, trading stock on hand is required to be valued at the end of the tax year. Any movements in the trading stock balance must be accounted for by adjusting either assessable income when the balance has increased or adjusting deductions when the balance has decreased.